got, a pretty good understanding of the macro, as good as you can get. The understanding that there's been massive overconfidence driven to the 60-40 portfolio by this, constant and persistent supply of capital and downward pressure on interest rates. So you have a world of investors who are probably overinvested and overconfident in the 60-40 portfolio. As Rodrigo alluded to, they've just been saved so many times. They're the quintessential turkey roaming around the farmer's yard, thinking that, man, am I ever getting fed well with Thanksgiving just around the corner? And so I think this dovetails well into how you approach this problem in your portfolio, how your portfolio complements the 60-40. Maybe walk us through that, because I think that has real value to the listeners.
Yeah, in the context of global macro, it has great stories, but oftentimes you can have the thesis right, but the bet wrong. And I think, this is one of the challenges of being a global macro manager. And I think you have done a good job of solving that problem. So if you could, how does the rubber meet the road here?
Okay, first very important point is that I use this analogy. I mean, I find that the industry tends to be very polarized between bulls and bears, right? If you go into Twitter or whatever, it's all about I'm right, you're wrong, black or white, up or down. It's all polarized. I'm a team player, and my view is that your portfolio is a team, and I mean the team in the sports in the sports sense. Okay, in soccer. You might argue who the best player in the world is, maybe Lionel Messi. Okay, now if you build a team with 11 Lionel Messis, you are destroyed. I mean, and I'm sorry to say this, but every other corner they would score a header because he's like 160 something, right? So the fact that he's the best player in the world doesn't mean that your team, a team of 11 Messis, will be great. So the way most people play this game. And there's a few messages I want to pass across. The first message I want to pass across is this idea that investing is about making money. It's the equivalent of, if you're playing sports, it's about scoring goals. Okay, anybody who's played any sports know it's about offense and defense. I mean, take someone like Roger Federer. Okay, everybody knows his attack. He's an insane defender. Okay, and he's faster than anybody, and he's insane, right? It's not just the flashy forehand. He's an incredible defender, right? And that applies to many. So many people think that investing is about making money, and they are building portfolios with 11 strikers. Every single piece of the portfolio is trying to make income and capital gains. And this is partially due to this mindset, and partially due to this the central bank having my back and the complacency. Now, the way we think about this is we think about it as a team. So you need strikers, and the ideal striker is a call option on equity. Okay, something that will pay you handsomely in a risk-on market, but will protect the downside. Yeah, and then you have defenders and goalkeepers, which are effectively, ideally, put options. Okay, so they score you, they make a lot of money in the crisis, and they won't blow you up on when things go wrong. So you want to have a team where you have, why is Barcelona or Real Madrid where they're so good? Well, Luis Suarez has 5 chances, he scores 2 or 3, and they shoot 10 times, and the goalkeeper saves 9. I mean, that's how you win the match, right? So effectively, you need the best strikers, the best goalkeepers, and then you need to embrace the volatility and the stupidity of the market. Okay, most people think this is about having a black box, a crystal ball that, I have the ability to time the market perfectly and blah, blah, blah. No, this is more about the opposite. It's about embracing this volatility and saying, look, I have strikers, I have goalkeepers, I find the neutral position, which might be 50-50. And there will be times where this goes 60-40 or 70-30, and there are times that it goes the other way. But the idea is you just go back to neutral. You just buy cheap, sell expensive, buy cheap. So in that portfolio construct, we are the goalkeeper. Okay, and there are other people out there that they are more pretending that, look, if the market's up 30%, I'll make you money. If the market's down 30%, I'll make you money. To me, it's a bit easier. That's pretending to score all the goals and do all the saves. To me, it's a bit easier just to play one role and to do your job really well. Okay, and that's it. We are goalkeepers, and this is what we do. So we're up, call it 10% in 2018, flat 2019, up 40% in 2020. If you complement that with someone that does the opposite, and you can rebalance, you're in business. Okay, so the 60-40 balance, I'm going to tie it up with something else. So the first concept is you need a team, and you need a team at all times. I mean, Barcelona or Real Madrid, they play a third division team, they still have a goalkeeper. They still have 4 defenders. It's not like, oh, this is such an easy match that, you know, let's just put the strikers and we'll win 7-0. No, you have goalkeepers, you have defenders, you have midfielders, you have strikers. And this will happen pretty much in any match, right? And so it's this idea of thinking about your team, and there might be, you know, if you could build a team with great bull like Michael Jordan and a great bear like Singletary, then it's better than you know, just having them fight each other. So this is very important. Now, in the context of all the macro discussion we've had, what is the right striker? What is the right midfielder? What is the right defender and goalkeeper? And I think the next 10 years, we really need to put this inflation hat on. So to me, equities are a better striker than credit. Because if you buy a Telefonica 20-year bond that will pay me 100 euros in 20 years, guess what? I don't think those 100 euros in 20 years are going to buy me much at all. Okay, so my credit may have given me some income, but the reality is this game has 3 levels. First, we need to make money in nominal terms, which is not easy. Your $100 should be worth more in the future. Second, you need to make money in real terms. So even if you made 5%, if inflation is 20%, it's pointless because you still lost 15 in real terms. And
it's sort of like a coin flip where heads you lose, tails you tie.
Exactly. So and then worse, the third level of the game is after tax. So you either get stolen through inflation or you get stolen from taxes. It's incredibly difficult. So you have to win in nominal, real, and after tax, right? So in that sense, when you build this team, you need the best striker you can, which in my view, I favor equities to credit. The midfielders, I favor real assets to cash. You don't need to be a genius to understand that in a world where interest rates are not going up and inflation's coming and you have real estate paying you some yield, it should be better than cash, which are being diluted. And to your question, Richard, then we have the goalkeepers. And here, I think anti-bubbles like gold or tips or options and the strategy that I run are superior to the conventional defenders, such as fixed income. And I use this analogy, I call the German Bund, I call it Beckenbauer, which it may mean nothing to you guys, but it was this unbelievable, legendary defender that Germany had in the may have been even West Germany at the time, that won the World Cup in 1974. And that he was an unbelievable defender, but he's now 74, 75 years old. So yes, Beckenbauer was a great defender, but not anymore. The Bund was a great defender, not anymore. And therefore, I think when you put this, you know, there are multiple ways in which you could analyze the portfolio. I mean, people like Chris Cole look at the world, you're either long vol or short vol. That's it. You know, everything's long vol, short vol. Other people might be risk on, risk off. Other people might be whatever. I think we need to add one dimension to this game, which is you're either long inflation or short inflation. And I think when you build this portfolio over the medium long term, you need to have the team. You need the best strikers you can, the best midfielders, the best goalkeepers. But within that, you need to apply this framework and understand that this is a game of, there are 2 rules. And I love, Warren Buffett has this saying, very famous. There are 2 rules for investing. Everybody knows them, right? First, never lose any money. And second, never forget rule number 1, right? And then he comes and loses 50 or 60% in a crisis, right? And I always ask, which rules were you playing by? With all due respect, which rules were you playing by? And the fact is that what he really means is that the first rule of this game is protect your capital. And the second rule is compound returns on your capital.
Sounds like you're describing risk parity there, almost.
No, because there's a big problem with risk parity, and this is a big part of where we tend to make a lot of money, right? There are anti-bubbles. There are assets that are grossly artificially cheap, and one of them is volatility. The 2 big moves we had in the last 2 years, Q4 18 and Q1 2020, where the VIX exploded. In both cases, we had the VIX going from about 10, 11. So artificially low volatility creates this perception of low risk. Okay, I compare it to driving a car at 200 miles an hour when the speedometer says 80. Okay, if you have an accident, boom, what do you feel? You feel the real speed you were running, regardless of what the speedometer was telling you. Well, guess what? Volatility is the speedometer of the markets. If you bought, going back to your turkey analogy, you bought a stock that is barely moving and it's just going up, you don't have a feeling of how much risk you're really running. But the turkey could come and you go boom in one day, right? Call it. So implied and realized volatility could be artificially low. They contribute to risk in both qualitative and quantitative ways. But the problem with risk parity was correlations. They were relying on correlations in a way that something that worked historically has been extrapolated. So perhaps their analysis told them that if equities, the yield in the bond would go to -5%. Sorry, mate, it's not going to go to -5. You have all the downside in the equity. You have the downside. So what happens when you have artificially low volatility and artificially low correlations is that you're running hidden leverage. And when shit hits the fan, both move at the same time. Volatility explodes, correlations move. I bought some options in February that were S&P puts contingent on the dollar higher. And the vanilla would have cost around 7%. I paid 60 basis points for this. Okay, so I got a 90% discount on a vanilla put by adding one condition, which is dollar up. In that case, dollar yen. Okay, the market said, no way. If S&P collapses, then obviously the yen is going to rally, dollar yen is going to collapse. And that was true in phase 1 when you had, because March, we went through about 4 phases. So DEFCON 1 was vol goes up and all the carry trades, boom, unwound. So Aussie yen went from whatever, 75 to 55, and dollar yen went from 109, 110 to 101. But then came the next wave, and then we started to see stress on the OIS markets and euro and the yen collapse. And we had this situation where things that were not supposed to happen happened. And then the S&P is down 3% and dollar yen's up 3%. And all the models are going like, what the hell is happening? This was not supposed to happen. And as an engineer, this is effectively what happens in fluid mechanics. Okay, you have a laminar regime, a world where relationships are linear, and you go into turbulent regime when things happen. Okay, and this is in a way the big blow-ups that you see in trading and risk management. They always come from either leverage, either direct or hidden, and very often from these positions like artificial low volatility, artificial low correlations. And this was what blew up Dalio and company in March because of this reliance. And I think I'm going to make another point here for the listeners, which is, we're up 40% without leverage, without any shorts, and only buying options. Why? This is the most as a goalkeeper, you have to be the most conservative you can. Leverage, if you, I had this article in the front page of the FT where I was calling for 3,000 to 5,000 gold within 3 to 5 years when gold was at 1,100, okay? And at that point in time, the view was very similar to what we've discussed today. I'm a chess player, so I was just a bit early. I could see what was happening. And so people might say, Diego, wow, why don't you sell your house, buy gold, lever it up in futures, and you'll be a millionaire or gazillionaire, whatever you want. And the answer is, no, I'm going to be bankrupt. Because when you lever yourself a lot, the market will take you out. So leverage in linear form, no. Long short, okay, Brent WTI, Tesla Ford, okay, whatever, yeah? People were like, okay, Tesla is a terrible investment. I'm going to go short. And, you could either do a long short, which is a bit of a problem, or you could say, and this is another typical problem, is I'm going to buy puts and I'm going to finance my puts by selling calls. And my answer is always, dude, you're not financing anything. You're long puts and you're short calls. And you just blew up. And this idea of financing zero premium effectively creates hidden leverage, either direct, which is not hidden at all, or long short, which creates these blow-ups through volatility and correlation, okay, or through option structures where you short options. And this is the reason why, trust me, I know how to sell options. I could do that. It's not that hard, okay? But it's self-imposed discipline to create a process where you need to find the cheapest available option that will be the most explosive with the best carry. And this is what we set to do as a goalkeeper, and what hopefully we'll continue to do. It's not easy, and it's very tough.
Diego, when you're creating that structure that you mentioned, the sort of the short dollar, short markets, are you doing that through listed options? Are you doing that through a combination of option contracts and futures? Or do you buy a non-listed option that you source through a bank?
Yeah, we have we source that through banks. If you think about the tools available for us as investors, both to trade the market and to have information about the market, there are multiple dimensions. The first one is pretty simple, is spot trading. Yeah, you just buy and sell something, and that's it. Gold, up or down. You buy your future. There's not a lot to discuss, right? How much information do you get from gold price action? Whatever. The second thing you can look at is the term structure. Are we in contango? Are we in backwardation? Shall I play time spreads? And you put positions that effectively give you more information about what's happening. In commodity markets, once you go into backwardation, generally it's a very, very big signal. The third level is options markets, which is going to give you an estimation of the probability distribution and the shape of the curve and the skews and what is effectively being priced in. So you know where you are, you know what the financing conditions are, you know the supply and demand of insurance, and then you can go on, and you could actually add a fourth dimension, which is called correlation. So think, for example, about one asset called gold, dollar gold, and another asset called euro dollar. Okay, what's the relationship between gold and euro? Okay, I know what gold is, the term structure, how it moves, and then I know what the euro is, the term structure and how it moves, and the options market. How does gold in euro behave? And if you think about gold in euro, in order to understand how gold in euro behaves, you need to make some assumptions on correlation, which might be rolling correlation. How has it moved in the last 6 months or whatever? And here you have two scenarios that are very interesting. One is the market is highly correlated, So gold and the euro are the same thing. This is what's happening today. Okay, the high correlation in the markets, we're just trading the dollar, either long or short. And you have this dynamic where the S&P and gold and the euro are the same thing. As far as I know, they're not the same thing. Okay, and there are times when these relationships change. And if the correlation went from +1 to -1, you would have something like this. And the time when these correlations tend to break during crisis, not only correlations break, volatility explodes. So you go from something that looks super stable, like gold in euro, low vol, high correlation, to effectively things blowing up, volatilities explode, correlations break, and these little tiny things can go boom. Okay, that's why we make 5 to 1, 10 to 1, 20 to 1, 50 to 1 in our bets, right? Because it's about, in order to make 50 to 1, you need to buy something incredibly cheap, right? That has the potential to do that. By construction, a 50 to 1, the market is giving an implied probability of 2%, which may be implied by what the market thinks, but might be under a laminar regime under certain assumptions.